One.
Good morning and welcome to Stock Market Today for Tuesday, November 26, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email giving you daily stock ideas to consider in your inbox every trading day before the market opens. So U.S. equities were higher in Monday's trading. The major indexes ended near the best levels of the day. Treasuries were stronger across the curve. Dollar was stronger versus the yen and the euro. Gold was down 50 basis points, and WTI crude was up 40 basis points. If we look at the market from a sector perspective, tech and healthcare led the charge, while utilities and REITs lagged the broader market. As we get to the desk this morning, S&P futures are a little changed after that strong move higher yesterday. Asian markets were mixed overnight, and European markets are mostly lower, though the pullback is limited. Treasuries are stronger, with the curve flattening. The dollar is little changed against the yen and the euro. Gold up 10 basis points, and WTI crude is up 30 basis points. And let's take a look at the structure of the S&P 500 here. Another record high for the S&P 500, and you can add the Qs to that list as well. QQQ traded at a record high yesterday. Key support for the S&P 500 is still at that rising 200-day moving average, which continues to trend higher, 29.20, the level there. Near-term support, 30.30 to 30.50 in that range. We've identified it here on the chart for you, and then below that, let's call the key round number of 3,000. A near-term support level. The RSI is once again overbought. Goes out yesterday at a 72 mark. Couple of ways to think about RSI. And the way that I like to think about it is first and foremost as a trend confirmation tool. The fact that we can become overbought tells you that the trend to the upside is strong. So when I think about it from a trend perspective, a strategic view on the market, that's a bullish sign. When I think a little bit more tactically, though, it maybe probably makes you want to become a little bit more selective with your ideas in the near term, right? Overbought is not necessarily a good thing or a bad thing in and of itself. It's just the information that it's giving you is how I like to use it. And as always, I like to use it in conjunction with other indicators, such as the Chaikin money flow indicator, which is solidly bullish with this move higher in equities. So market continues to trend higher. New all-time highs confirmed by our indicators, folks. That is bullish. Let's take a look at our market in a minute now. What are we writing about today in our note to Chaikin Analytics clients? Well, it's Tuesday. It's relative strength day, so we're obviously going to talk about sector relative strength. But first, major markets close higher on the day, as we said. SPY and Qs go out at records. What was interesting to me, probably the best development of the day, was the IWM breaking above that key 160 level, and we're going to look at that chart. IWM's up over 2% on the day yesterday. We're seeing some solid bullish relative strength in healthcare, while the bond proxies and the consumer groups continue to lag. Remember, last week we looked at the bond proxies breaking down on a relative basis. This week we're going to look at the consumer groups, and futures point to a flat to slightly higher open here this morning. Now, from a power bar perspective, they improved yesterday. Dow's still negative, but 5 bulls to 6 bears after a 69 basis point rally yesterday. Add 0.75% for the S&P 500 and take the power bar ratio to 129 to 86. NASDAQ was an outperformer on the day, up 1.16%, 30 to 13 bulls to bears. Check out the small caps, up 2.13% on the day, 709 bulls, 273 bears. That would give you a roughly 2.6 to 1 bull to bear ratio. Despite the risk on move in the market, bonds also rallied up 29 basis points to send yields lower. And at the sector level, as we said, it was technology leading the charge, up 1.46% on the day, 22 to 6 bulls to bears. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. The major markets are mixed. Let's hit our stock of the day now. From the insurance group within the now outperforming financial sector, First American Financial closed at 62.91, up 48 basis points yesterday. FAF, the ticker symbol there, has a very bullish Chaikin Power Gauge rating due to very attractive financial metrics, very strong earnings performance, and very positive expert activity. Stock has some near-term weakness in technicals, largely a function of money flow. So let's take a look. 20 factors, 5 in each of these categories, gives us this very bullish rating for a strong trend above the rising long-term trend line in a strong industry group. Insurance has been market leadership. Market and model are in agreement. This stock has been bullish since mid-January, and for the most part has continued throughout 2019, and for the most part has been an outperformer. Nice steady uptrend, continues to outperform. Overbought, oversold indicator moving towards an oversold condition. My only real concern here with this stock is the bearish money flow readings with the stock making new highs, right? Back in May when the stock was making new highs, we had solid bullish readings, right? The stock was being accumulated and pullbacks for buying opportunities. Now it looks as if strength is being sold. I would try to give this one some time to see how it plays out. It's a good looking stock. The weight of the evidence supports being there, right? Very bullish stock, outperforming the market, getting close to oversold, strong industry group. The money flow is kind of the one factor that I'm taking a look at there that gives me a little bit of pause, but all else being equal, it's a pretty good looking stock. Let's take a look at our sector tracker now. Moving to the major sectors over the last 5 days, we've been talking about healthcare, right? We've been highlighting healthcare at the top of this list for the past few days. Well, we're going to look at a chart that shows you exactly what that looks like. It's in the number one slot over the past 5 days, up 2.35%. Energy, a little bit of a counter trend move in energy. Financials continuing to do well. Recent emerging leadership that we've been talking about. We love to see tech in the green. We love to see tech outperforming. It's over 20% of the S&P 500. Middle of the road, industrials and comms are positive. Discretionary and staples are negative. Utes, materials, and REITs towards the bottom of the list. So your defensive bond proxies continuing to underperform. We looked at that chart on this show last week. They look very much the same. We're going to look at the consumer groups a little bit later on today, but continue to focus on the leading areas of the market for your bullish ideas. Avoid the lagging areas of the market, such as telecom services, our industry in focus today, which over the past 6 months has been an underperformer, lagging the S&P 500 by over 8%. Power bar ratio, which measures future potential, hints at more to come. It's weak. 12 bearish or very bearish stocks for 5 bullish or very bullish stocks. It's currently ranked number 19 of the 21 subsectors that we track. It did move up one slot over the past week, but 19 out of 21, not really anything to get excited about. So the indicative stocks there driving the performance to the downside: Vonage, VG, Viasat, VSAT, and Boingo Wireless, WIFI, all with very bearish Chaikin power gauge ratings. And when we look at the chart, I mean, it speaks for itself, right? Neutral Chaikin power gauge ETF rating. The trend is strong because it's above the trend line, but really we've gone nowhere. We have the Qs breaking to all-time highs. We have the SPY breaking to all-time highs. We have the IWM breaking out of its range. Why would you ever want to consider a chart that looks like this? Skirt to the relative strength. This group has been an underperformer consistently since March. It's under distribution as Chaikin money flow has turned bearish and solidly bearish. It's currently overbought or rounding out of an overbought condition. It's just not an area of the market where we can get excited. Just don't see a lot of opportunity for bullish ideas. Maybe you want to scout out some of these bearish stocks. If you're looking for some bearish opportunities in the portfolio, there are 12 in this group to choose from. But in terms of, taking advantage and riding the trend in the market, this is not an area where we would currently be spending a lot of time. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. L Brands continues to move higher. They're talking to some advisors about strategic alternatives. That sent that stock higher by 6% on the day. Tiffany being bought by LVMH, that stock higher. And once a deal is announced, you generally see a lot of downgrades as a function of the deal being announced. Not so much a call on the stock, more a call on they're going to be taken out. INCY up nearly 6%, traded to a 52-week high yesterday. Didn't see anything company specific to drive the trading in that name on the day. Nvidia caught an upgrade from Morgan Stanley. And based on my past roles, I've read a lot of research. I think Morgan Stanley does some good tech research. So the upgrade there juiced the stock by nearly 5% on the day. And finally, Capri, there were some positive comments from a sell-side research shop, as well as increase of the price target after spending time with the management team. Capri up nearly 5% on the day. On the loser side of the board, JEC, earnings send that stock lower by 2.8%. Smucker reversing the earnings-driven gains from the previous day on a cautious Wall Street Journal article. The carriers were lower on the day yesterday. That dragged Dish down by 2.25%. IDXX down 2%. A bearish stock down 2% on a solidly strong day in the market. Same for Tesco. TSCO down 1.5% on a solidly bullish day for the equity market. That stock has a bearish rating. Nothing company specific driving the trading in each of those names, but more just a function of weak stocks being sold off despite the rally in the marketplace on the day yesterday. So let's take a look at what we're talking about. The charts, the highlights in our note today. First and foremost, small caps join the breakout party. Here's the IWM. We've looked at this chart numerous times in numerous ways, whether it was relative performance or absolute performance, and we've persistently said it's been an underperformer. We'd love to see a breakthrough 160. So yesterday we've got in our breakthrough 160. The fund is above a rising 200-day moving average. This range, let's call the low at 144, the high at 160, is 16 points wide. So should the breakout hold and we want to start to think about where the IWM can go, well, we want to add 16 points to the top of the breakout. Breakout was at 160, add 16 points there. You get $176 as a potential upside objective just using classical charting techniques for IWM here. Momentum is with the trend. The RSI is in bullish ranges. Notice that during the consolidation, it failed to become oversold. That was a clue that odds favored an upside resolution, but we never want to front run these situations. We want to take the time to wait for the breakout, which we now have. What's interesting here and what we're still watching is relative performance against the SPY. Clear downtrend, right? And the predominantly our view on small caps has been one of a relative call, right? We've been saying that we just favor large caps over small caps, but look at what's starting to happen here with that move higher yesterday. We have a break of this downtrend line. Start to pay attention to the relative strength in IWM, right? Similar to what we saw in value. When value started to outperform, we said to start paying attention, and then it started to follow through, and then the value theme started to pick up some pace. Well, that's how we want to think about the IWMs here, and that's how we want to think about small caps. Remember, we started to highlight some small cap breakouts. Remember last week, we highlighted small cap tech as breaking out. Now we're seeing small caps in general starting to work higher. Check out the Bullish ETF rating and look at that power bar ratio, 709 to 273. Following that 2.13% move higher for the IWMs yesterday. Start to pay attention here. Start to drill down on the areas of small caps that are doing well and see if the small caps in general follow through. Same as what we did last week with small cap tech. We're starting to see it. Strong relative move in healthcare. Here's what we're talking about. Here's the XLV relative to the S&P 500, the SPY, right? It's been an underperformer since the market lows back in December. Went into this consolidation, is now breaking topside from the consolidation and above the 200-day moving average for the ratio. And that move is being confirmed by momentum. Look at the RSI of the ratio. Getting to an overbought level on this move, okay. Remember what I said about RSI. It's a sign of momentum confirmation. Overbought tells you that the trend was strong. Contrast that with what happened off this move, the initial move, right? From deeply oversold positions, we had a strong relative move higher that could not produce an overbought reading. And we subsequently started to trend lower. Now we are breaking out. There's better momentum confirmation here from the RSI after a series of higher lows. That's how you like to think about your indicators. You want to understand their personality, right? And understand the difference between overbought and oversold, but also what it means when you fail to become overbought in a situation like this. And then you do, as we are currently. Take a look at XLV on an absolute basis, breaking to new highs at the 99.41 level. Coming out of this consolidation, for those of you who wanted to draw the ascending trend line, you have a low down here at around 80 and a high up here at around 93. So 13 points is the pattern that you can add to the $93 level to come up with a potential upside objective for XLV that has a very bullish ETF rating, 33-2. Bulls to bears. And then finally, sorry, sensitive mouse, here's the consumer sectors under pressure. Top panel, discretionary versus the market, rolling over, now testing support. The bottom panel, staples against the market. Interesting that they are both underperforming at the same time. But just like we looked at the defensive bond proxies last week, underperforming, the consumer groups are underperforming. These are areas of the market where we do not want to focus for long ideas currently. It's going to wrap it up for today. I'll be back tomorrow. Have a great day, everyone.